and welcome to subsection 4 of section 3, where we talk about Wyckoff. So at this point, you must have read through the stock charts website and actually understood why and how these points form. And again, or you didn't, but you should have studied and went back through some of your charts, found some areas like this, circled some, found some unmitigated or potentially valid areas of supply and demand where orders had to be mitigated, or found areas where Wyckoff has occurred, labeled it multiple times, and understood how, when it forms, and how after breaking structure, it either breaks down completely and begins the mark down in phase E or the mark up in phase E based on whether you are upside down or not, right? Because remember, it's all the same thing, just different labels. So hopefully I can go back and just undo all these labels so I can be back on the other side. So I can reflip this to the normal side. There we go. Right. There we go. Perfect. So yeah, this is the accumulation and this is distribution. Hopefully you understand this now, because as I now talk through price and work through it, I'm not going to go through and, showcase every single point. We will with webinars and things of that nature, because it's not something that's really easy to catch up on, especially if you've been watching this section without kind of going back into your own charts and looking at these places. But ultimately, you can now begin to see very clearly how a lot of these things can be put together, in the sense that from the very first video, you understood how to look at order flow from a standpoint of normal, overall, overarching structure, and anticipate potential moves in that structure, right? That already on its own is a large tool. On top of that, you have the idea of candlestick structure, which can be confirmed along with your order flow structure, and now can be used as a double confirmation to potentially get involved in overall structure. And again, that overall order flow structure, you better be writing this down because it's going to get really confusing if you don't, so you can follow it, can also be confirmed using your mentfx block structure, which is an overall way of looking at huge areas of supply and demand as they move with the orders that are put into the market. And again, we expect these points not to be traded through. Why? Because if they are to take prices on a bullish or bearish way, right, especially if order flow is shifted that way, they will not get below certain points that act as those final points that are like lows, right? Whether it's order flow or whether it's mentfx blocks or something of that nature. Now, on top of that, so now you have multiple structure confirmation. On top of that, you understand how you can use your structure confirmation, your candlestick breaks, and your order flow breaks to determine valid supply and demand points across multiple time frames on any. And you understand how you can find them potentially and expect potential mitigation. Now, on top of that, and even before that, your expected mitigation, you understood, could be confirmed using smaller candlestick structure, using smaller mentfx block structure, and using shifts of that nature that form new, unmitigated supply and demand zones. Now, on top of that, you've taken it the extra step and understood that all of those things can also be explained away or viewed in terms of a schematic that shows you candlestick structure, supply and demand zone mitigation, overall mentfx block validation by way of Wyckoff. And you have understood that Wyckoff forms in a number of ways, a number of times, always across multiple time frames. And you understand that if you were to just trade Wyckoff, this is something that's very important, if you were just to trade Wyckoff, it would make your life almost impossible, because Wyckoff occurs everywhere, and this transfer of buys into sells or sells into buys even happens when you're in a bullish bias. So most of the time when you're in an overall order flow bullish bias, you're going to have more sells on behalf of the dumb money transferred into buys by composite man, right? And those buys will be taking to new liquidity points higher, new structural points higher, thereby acting as potential areas of profit taking, right? So you're going to have more of that occurring. But despite that happening, there will still be pullbacks. There will still be big moves within ranges, within higher time frame ranges on lower time frames, that will show you a multitude of accumulations into distributions, into new accumulations, into reaccumulations, and all that other fun stuff. And again, we will talk about reaccumulations and redistribution in either this subsection or the next one. But most importantly right now, we need to talk about how you can put some of these things together And why understanding these schematics, despite the fact they happen everywhere, is important. So one, you understand there's two main types of schematics. So even though schematics may present themselves like so to you, and it might be super ugly, or in some cases even like this, right? And then just take off without you and there's no opportunity to get in, you understand that a schematic is undergoing. And you understand why it did what it did, you understand why it liquidated certain areas, and you understand why it's marking up or marking down based on overall potential structure, which you have learned in section 1 and 2, which is again why you should go and check those out to make sure that you have those fully understood and you've tested them, and you almost have a system around just structure and stuff like that, right? The reason we understand Wyckoff, or we look to understand areas like this, is because now, instead of being somewhat ambivalent and unsure about certain areas and price coming into it and maybe giving you a mentfx block, you can use those areas to confirm the actual mitigation of that area and potential continuation in a given order flow sentiment or bullish or bearish bias by using Wyckoff confirmation, which shows you ultimately that there is really that contextually we are actually undergoing this transfer from all the sellers in the market to the overall smart money institutional side buyers that can now take the market higher. And by putting that together with your idea of overall structure plus candlestick structure plus areas of unmitigated supply being met with even smaller Wyckoff, which is made into larger Wyckoff, which is then met with the moves down, will give you opportunities to get involved in sells here, in sells on this overall Wyckoff schematic, and potentially even on the moves back into the tests of new schematics that form on higher time frames, okay? So you are starting to see how together these tools can be very powerful, because even though they are very intercorrelated and very similar, the fact that you take the extra step to understand a movement of Wyckoff and how these phases are underwent and how liquidity is created and engineered and then manipulated is going to help you a lot more in potentially getting even better entries, okay? So now that you have these and you have them drawn, you have them written down, we can talk a little bit about why we determine areas that we look for interest and why we do what we do. So very quickly, you should already understand that when we look at a market and when we determine certain areas that we want to be buyers and sellers at, so in this case, let's go to a 15-minute, I guess. It's a little bit ugly right now. So maybe, I think Bitcoin was quite beautiful. Sure, doesn't really matter. So the reason that we draw out overall structural play, so in this case, let's zoom out and let's just think about what's going on here, right? Order flow-wise, we had this happening, we had the break of that, and then as you can see, as prices made a big move up, without getting any higher than this, because what's up here? The last mentfx block, right? This is a mentfx block. That's why this price is mitigating here. It also mitigated by way of what? Wyckoff, okay? And it also created that order flow point. Moved lower, created a new order flow point. Moved lower, created a new potential order flow point. Now, the reason we have areas that we draw in, the reason we understand points of interest on behalf of supply and demand zones that were created with unmitigated points is because we also know that Wyckoff happens everywhere. And because it happens everywhere, it's hard to trade on its own. But when you partner that with an idea about where you believe price is going to go, which we call a bias, when you partner your bias with Wyckoff confirmation and you have Wyckoff undergo its distribution or accumulation, so transferring those buys to sells or sells to buy in your area, your confirmation and the probability of price holding as per your bias increases dramatically. And as a result, you are able to either continue to wait for more confirmation and get even better RR, or confirm certain areas based on all the price action that's happening to get involved at those areas. So as you can see, price has been breaking down relatively. So let's maybe go to a 4 hour so we can see this a little bit better. But on Bitcoin itself, okay, and again, we will do some weekly outlooks together in the webinar, and we'll keep doing that. But as you can see, when price finally made the shift, which on this time frame was done with the shift of the overall, so this would be like a break of structure, right? When this overall break of structure happened, the point we left behind, as you can see, that's unmitigated, no question about it, is this last up move before the down move. And if we draw that out, just like so, you can see exactly where price mitigated. Now, again, you could have had sells that look something like this, right? And this would be very risky. and it's a 1 to 2.8, which is fine. It's still positive RR, but this is significantly more risky than waiting for potential mitigation that might give you extra confluence. Now, itself, we know, based on the snowflake rule, that you can see the mitigation here, there is Wyckoff here, but it's very, very ugly on the 4 hour. Working your way through the time frames, though, begins to put in a completely different perspective. Now, in this case, based on what we've taught you, you can see that still the actual Wyckoff present here is very hard to spot. In the case that you have a buying climax, maybe an AR, an ST, kind of sign of weakness, an upthrust, a breakdown, and then the test. So in reality, there actually is a Wyckoff schematic here that you can mark up, right? You can see a huge move up, an actual stopping action, preliminary supply. A move up to the buying climax. A move down to your first swing, that's your AR. To the move up that comes and tests the BC, or around it, or under it, that's the ST. The move down that creates a sign of weakness in phase B. The move up that liquidates it, that makes the UT. And the breakdown, which is a sign of weakness that breaks structure. And after that, we have this move back up to test the final areas of supply left behind, right? And that's already an even more valid sell. So already, just by waiting a little bit on this lower time frame, and again, this can happen on any time frame, you validated a potential schematic that now can be traded at the last up move before the down move. So now, that same setup that was a sell, that same sell at this point, exactly from the same area pretty much, has now, instead of become a 1 to 2.8, at the same low, which is structure, has become a 1 to 5. You've doubled your potential gain on this by waiting. Now, similarly, you get even lower and use the same area as a potential area of interest, and instead of not getting involved, you wait. What do you begin to see? You again see your big move up, a potential stopping action, a potential buying climax, right? But then nothing really happens. So this could be your stopping action, okay? Boom, buying climax. Huge move down, you get a new swing. That's your AR. Right, so again, I'm not going to label this perfectly for you, only because we've went over the in-depth labeling. So you should be able to see the labels as I do this. And actually, I will label this for you. But again, you move this up. You take this up higher. Secondary test. Fantastic. UT. Now, what's interesting is at this point, notice what price does. It does break below. And at that point, you are confirmed for potentially this Wyckoff to hold. And in this case, I might have even sold on this pullback to come and take it lower. Wyckoff will not always give you perfect setups. And oftentimes, when you have a sign of weakness, you can write this down too, you want to see the sign of weakness actually show you that real sellers are entering the market. What I mean by that is if this move here closed here or even came lower, then I'd be even more happy to go with the sell. But because of this and the way it's moved, I would actually most likely look for a confirmation within here, which you can see we possibly never got due to this. But if we continue following this, we now recognize that we are actually in an overall type 1 schematic. So this was a UT, and if this happened, this would be a type 2 schematic. But what actually happened is we had the move up, the new high get created within that same area where we were expecting sells from. So again, one of the most important things about Wyckoff, and you got to write this down right here, is that Wyckoff does not determine your direction. Wyckoff confirms your direction. That's it. We wait for Wyckoff to occur to get involved in the market at a much higher probabilistic sense of our bias that we've already preset holding. We do not use Wyckoff to say, oh, Wyckoff accumulation is undergoing, we should buy here. Even though this buy might have worked after this Wyckoff accumulation and it moved higher, the reality is our overall bias was already bearish. So the reality is we would have had areas of supply that we'd be looking for sells at. And on the other end, if we had actually expected this, which is now your bias because we're in a bearish market, we'd be expecting what? The stopping action, right? A potential buying climax, an AR, an ST, an up thrust, a breakdown, and at those points, we are good to go for sells. And as a result, you can see price makes its way back up. So you have sells from here. You also have sells as price comes back in. And what do you see inside of here? You can already see it. But guess what? On a 5-minute or even a lower time frame, inside of here, you have more Wyckoff confirmation. Buying climax, AR, ST, sign of weakness, up thrust, UTAD, breakdown, test, confirmation, continues way lower. Okay? So you need to recognize that Wyckoff happens everywhere. And based on the area of your POI, so what I mean by that is based on how large your area of supply and demand is, you need to calculate your area of Wyckoff along with that, right? So if I had a zone right here that I wanted to confirm on, so again, this is not actually a good zone. Let's actually just use a higher zone, just one that actually worked, like this one, right? So unmitigated, you have the last down move before the up move. The fact that we're on a 15-minute chart should lead you to believe that we can't have a 15-minute Wyckoff on here, really. It could happen, and actually it kind of did, but it's much lower likelihood. But to get a real move from here, there could be a Wyckoff confirmation on, for instance, a 3-minute, 1 minute, or something of that sort, right? And the second you get down to those levels, notice what you see at that same point. So let's lock this in so it doesn't move. There we go. Right? Price comes into there, and now the story's different. Now, and this is something we'll talk about in a second, but if we overall just look at this price action, we can see that real Wyckoff starts to really come in at or around these points here with these lower prices, right? You have selling climax, the AR. So this is all like a stopping action, ultimately. And then you can follow it from here. The selling climax, into the AR, into the ST that tests it, creating those equal lows, right? Into an SOS and B, getting just above there, like we've spoken about. Creating that ST in phase B that acts as a spring, but we don't know that yet until this comes in and this comes in. This is now your sign of strength. This is your sign of strength. And now your last areas of demand, which are also parts of this mentfx block, which is a shift, which are also parts of this demand zone, right? This overall demand zone shift in candlestick structure is where you see price come to test it. And if we use that as an area that was a demand zone, notice how if we zoom in, there's Wyckoff here as well. Your selling climax, or you could say your potential stopping action, your selling climax, your AR, your ST and B, your spring, right? Your potential move up that does not break anything yet, your actual spring. So in this case, what actually is happening is we're having multiple liquidity zones created. So in this case, you could get even a little bit higher and work around this, but ultimately you can have multiple STs. So in this case, this would be an ST, this would also be an ST, and this would be your ST and B, and this would be your spring, right? The only thing that matters is that we start to shift overall structure. Now, structure starts to shift here, but notice how Wyckoff hasn't shifted yet, okay? What I mean by that is if this is your schematic right here, Wyckoff will only be validated at these points right here. So you'd be waiting for these breaks here. Now, at these breaks, you are valid to go for buys, or you're valid to wait for potential re-entries as price makes its way back down. And notice how as price makes its way back down, not only does it test the schematic, because it hasn't tested it after it took off, it also undergoes what? A new schematic. And again, I mean, I haven't looked at these before, but again, you can see that there are schematics undergoing in these areas. And how so? Well, follow it down. You have a big move down, you have finally huge stopping action. You have areas where price is really kind of stopping, right? If you don't like that, you can use these areas here. Big move down, stopping action, selling climax. Okay? Follow that up to your what? Your AR. Follow that down to your next swing. That's your ST. Creating what? Liquidity. Follow that up, nothing really happens, to the breakdown. The second we make a swing below the selling climax or the ST, remember the ST, right? This doesn't have to happen. We make an ST and B. So at this point, you can see there's actually a swing here. That could be considered your ST and B. I wouldn't consider it just because it's not like a real swing. But this right here is. Here's your swing. That's your ST and B. What do you have? A type 2 accumulation again. How do we confirm it though? We have to wait for the break up. We have the sign of strength. And guess what? Remember that wick? In this case, it's a body. It's showing you that bullish intent, whether it's on the 1 minute, 5 minute, whatever minute it's on, has been shifted bullish. Follow that down to your last actual demand zone, the last down move before the up move, and notice where price comes to test. Now again, you can go and refine this on the lower seconds, and you'll notice that there's probably one that's even lower, like in here, and that's where price is testing. And as it tests that, you also notice that we have shifted in terms of mentfx blocks. The mentfx blocks have shifted bullish, and you could wait for a second confirmation of that, which would happen where? Right here. And then you can look for entries right off the buy stops as it breaks higher. Now, if you didn't want that, notice what's happening inside of this same area where we could have entered on a lower time frame. So forget that we're on these time frames. Just remember that on a lower time frame, what do you see here? Lows being liquidated, potential STBs, breaks higher. What do you see here? Right? Selling climax, AR, ST, sign of strength in phase B, ST in phase B. That also acts in the spring. In this case, there's no spring. Wait for the breaks and the breaks happen. And at those points, you're good to go for buys off of potentially new structural lows, off of new structural demand zones for the real markups in overall price, okay? And even though you can see it comes back down, you can see where it came back down to. The overall schematic that happened here came to retest it and continued higher. And there's a ton of pips, or not pips, but there's a ton of profit for you to be able to make and partial on your way up. And by partials, I mean, normal structural highs, more structure here, potentially supply zones in these zones here, right? So you can see that, price came a little bit higher if you were aiming for even higher prices, but this is how you could partial as well. And we'll talk about risk management in future videos. But ultimately, again, I didn't look at any of this price action beforehand, so I'm kind of doing this as we're talking, but you're seeing how potential areas that you've designated will have, if they want to hold, Wyckoff undergo in that area based on the timeframes you're looking at. This is why timeframe trading and understanding fractals is key to actually trading this specific way. Based on the area that you're looking at of a specific time frame, your actual Wyckoff schematics will be delivered to you on different time frames, okay? So let's get rid of this. We don't want to look at this anymore. Let's take a look at EU. There was a great schematic on EU that happened sometime last week. All of these trades right here, and again, work through mentfx trade ideas, were Wyckoff schematics on very, very low time frames. It's the same thing, but if we were to work with what we have right now, let me go find the area that this actually occurred in, so I can find that for you. Yeah. So right here, okay. You can, from looking at this, right? Just let's look at this from a standpoint of structure, overall structure, right? You can tell that we're overall potentially moving bullish, as you can see, right? You might use this as your bullish play if you are on a lower time frame potentially, right? Like something like this, just like that, right? You can see these bullish plays. Now, the second we put in these overall structural order flow shifts, we understand that we're also shifting in terms of candlesticks, okay? Now, if we go back to the 1 hour or 4 hour, we can easily go back in time and find the supply zones that caused some of these moves that happened, right? Where's the last unmitigated supply zone? Right here. The last up move before the down move. Similarly, you could have also used this one. These are both fully valid supply zones. Now, at this point, you don't know if price wanted to make a move towards these points and sell off, or towards this point and sell off. How do we know? Well, number one is we've already confirmed that we want to be bearish, right? And number two is that we said if we're going to be bearish, we are going to look for Wyckoff confirmation, which is the transfer of what? The buys into sellers at those points. And if we see that occur, we are happy to go with sells. Now, because we're looking at a 1 hour area, it is much riskier to look for a 1 minute confirmation within this area. Why? Because on a 1 minute time frame, this actual price action, as you can see, so in this case it actually worked, but the actual price action is a lot more dynamic and diverse. Now again, if you actually study this price action, the only time it came to mitigate this point was actually here. And as it mitigated it, actually I do think it came to the, if we use the actual high, I think it stayed just under it. Not sure, but I remember people got sells off this and it was beautiful. You can see that there is Wyckoff here, but it's relatively ugly. If you wanted to spot it, you have this move up, your bigger abruption, right? Into the buying climax, AR, into ST. There's a lot of moves here. And so you're finally in your UT, your UTAD, and you get the breakdowns, sign of weakness, and you have the tests in this phase that break down in price. And those are going to be entries for you based on how you look at supply and demand zone confirmations, as well as order flow confirmations. Now, on top of that, if you just for a second looked at this and zoomed out for a second, you'll actually see that that same mitigation was an overall Wyckoff schematic. Now, on this schematic, I actually took a loss before I took like a 1 to 80 win. Okay, and what I mean by that is, watch what happens. You have moves up, you have a big stop in price, you have the move up, and you have your potential buying climax. Follow that down to your automatic rally, okay? Or in this case, your automatic rally could be here, doesn't matter. All you need to understand is it's undergoing these phases. So let's just follow that down to a normal automatic rally, following that up to an ST. There's liquidity created. You follow that up to a UT. Right now, this UT did not tap into the actual point. I thought it did, so when I took the sell off of this break right here, I took a loss on this move back up. That's fine, it'll happen, okay? But at the same time, we noticed that it actually did not tap into our point, so we should not have even been selling. This is why I stress the importance of now drawing out your biases. When you have an idea or a belief about where price wants to go, that belief can be literally wrong let's say that belief could literally be wrong 95% of the time. But as long as you confirm that belief, the 5% of the time that that belief is confirmed, 4% of that time, you're going to be right. And that's all you need to be extremely profitable in this market. So even if I, for instance, say I want to be bearish here, I want to be bullish here, I want to be bullish here, I want to be bearish, let's find something that failed. Bearish here, bullish here, bullish, let's say bearish here and bearish here. That's fine. I can literally say I want to be bullish and bearish at all these areas. Now, until price comes here and gives me confirmation, it doesn't matter that I said I want to be there, right? If I say I want to be bullish here, if there's confirmation here, great, I can take those buys. That's one that's correct. If I want to be bullish here, though, and there's no confirmation, I'm wrong about it being bullish, but there's no confirmation, right? If I want to be bullish here and there's confirmation, then that's great. I'm right again. But if I want to be bearish here and it doesn't work, there's no confirmation either way. Most of the time, if you want to be bullish or bearish from an area, the only thing that will actually make you wrong is when you do wait for your confirmation that shows you that price is actually undergoing an area of accumulation distribution based on the schematics we spoke about. And if it undergoes that, should you be looking to get involved yourself? Because when it undergoes that from an area you believe it could be potentially bullish or bearish, then you know it's confirmed, right? Just because I have an area and price comes into it does not mean it's supposed to do this, right? Price can easily go, right? But this does not make me wrong. That's it. All you need, though, is we might be undergoing it. Oh, we've really undergone it. Oh, we really are. I want to look for tests, or I want to get involved in the supply and demand zones that form along the way and take that up. And as I do, I want to partial on the way, trade it to potential supply zones, whatever it may be, and you trade to those zones, okay? That's how Wyckoff should be used. So in this specific case, even though Wyckoff kind of occurred in the type 2 schematic here, the fact that it did not tap the actual supply zone that you expect it sells from means that you should not have been looking to be interested at these areas. But then price really did make a run for those highs. Now notice something interesting. We do have Wyckoff here. Now again, if I go to a higher time frame, notice what we still have. Wyckoff. Notice how the Wyckoff will still show itself to you on any and multiple time frames. The only difference is how you spot it and how the swings in it are kind of looking in terms of the cleanliness of the actual schematic. So in this case, it's actually more clean to look at it on a 15 minutes. How so? You have the move up into your buying climax, your move down into your automatic rally, right? Your move up into the secondary test, testing the areas of the buying climax. You move up into a UT that might be a type 2, but never tapped into the supply zone. So you're still expecting bearishness from here or from here, okay? Your potential sign of weakness in phase B, because you don't expect this to be the area that actually functions as a break lower, especially since, guess what? There's no momentum. Remember what we said? This is a wick. It's more of a liquidity grab than it is momentum. Momentum is shown you by literal pushes in a certain direction. When there's pushes, you know that you want to go that way. Okay, that's the idea of studying volume as well. We don't study volume because we can look at the candles to understand what volume is coming into the market. That's also something very vital. Wyckoff can be used with volume. Many people do. You do not need it. It's bullshit that you need it. You can see the same type of thing in candles, the way they form for you, and the way they confirm as they leave behind unmitigated supply and demand zones. So remember, the higher time frames gave us areas that gave us the opportunity to believe that price could be bearish at this area and this area. All we need to wait for now is the confirmation on behalf of Wyckoff. Why? Because that's showing us that that area is acting as a real point of mitigation that will also be a part of a larger move that will meet us with lower prices because they've transferred the buy orders on behalf of dumb money to the sell orders on behalf of the composite man. And the impulses and the way the price moves away and begins to break down in structure, as well as how it liquidates certain points, are what are going to function as the confirmations and the validations of overall distribution or accumulation schematics. So in this case, we are bearish. We make that UT. Now this sign of weakness is not powerful enough. It's just a sign of weakness in phase B. We follow that up. We make our UTAD. Okay. Now at this point, we are still not valid for for sells. Sorry. I myself got sells inside of this move down right here. There were 1 to 80 sells that we took down lower into the demand zones here. Now the reason I took sells here was not because there was a potential Wyckoff. This Wyckoff should only, if you're only trading this markup of this Wyckoff, you should only be trading it when it validates it with this move down. Now, The reason I was able to get involved in these areas here is because on a lower time frame within those same areas, I think it was on a 5-second chart, but I'm not going to go find that right now. Inside of here, what you have is you have breakdowns in price that are met with Wyckoff schematics inside of price action. So inside of here, on an even lower time frame, are Wyckoff schematics. Because remember, Wyckoff schematics can form in multiple time frames inside of schematics and outside of schematics. Let's talk about that for 1 second. You have to take notes on this. Please do. Please don't forget to. It's going to be a very simple thing. It's something that I've shared in the Discord, but now it's something that you should actually understand. And what I mean by that is, let's take a normal Wyckoff schematic. Okay? You have a move coming down, and you have finally a big move that makes your preliminary support, right? There's a big move back. Then you have finally your what? Selling climax, right? Your selling climax comes and gets made, right? It's a large selling climax, okay? We move that up, and it makes some kind of an AR, right? The AR comes down and makes maybe an ST, right? Comes up, maybe makes an area that tests the previous AR, breaks down to make an ST in phase B, right? Breaks up to make the what? Let's say this is a type 2 schematic. Comes to break and make a new sign of strength, right? Comes down, tests it, maybe even comes lower to test it, and then takes off, right? And makes the markup. And this is the mark. Oh my God, excuse my terrible handwriting. This right here is your markup, okay? Now, this overall is a schematic. We zoom out, and it's easier to see, right? So, it's harder to see because I'm zooming out, but if you actually look at the moves in here, right? Boom, boom, here. PS, selling climax, AR, ST, some kind of sign of strength, but doesn't get above the AR. ST and B, break above, shifting structure with impulse, thereby showing you that it's most likely an accumulation, the move back to test, continuation. Now what's interesting is the second we dive into it on a lower time frame, that same area begins to show us a little bit more. What do I mean by that? This same selling climax. Oh, sorry. Preliminary support, right? The large backup in price. The large selling climax. The AR, okay? The ST, creating liquidity, okay? The potential SOS and B, but not really, nothing really. The ST, the ST in phase B, okay? The sign of strength, the test, and the markup. Now what's interesting is the second you really get to a lower time frame, like I said, time frames do not determine your Wyckoff. You just need to determine them based on the actual movement of price. The second you zoom in, you notice something significantly more interesting. What do you notice? Right? Buying climax, AR, ST, sign of weakness in phase B, upthrust, test, LPS, and inside of there is another schematic, LPS, breakdown. As we get down to that selling climax, what do? We don't just make a selling climax with this. We go selling climax, AR, ST, potential upthrust, making just some liquidity in here, right? Maybe someone's trading this as a flag pattern. Doesn't matter. ST in phase B, that is part of this overall selling climax, right? Test, before breaks, sign of strength, validating the schematic with an overall mentfx block break as well. Remember, because all of these things are part of the same idea. As it liquidated all these lows, created all these demand zones, left behind demand zones in here potentially, right? Comes to make that LPS, and from there you can be a buyer because it's a lower time frame. We come up, look at the AR. What do you see in the AR? Okay, big stop in price, PSY, buying climax, AR, ST, sign of weakness, upthrust, breakdown. Now, you could be a seller here and take it lower, or you could wait for the demand zone to be traded into. Now, what do you see after the ST? It makes a very poor Wyckoff schematic and then takes off. There's a snowflake here. Maybe on a lower time frame, if you zoomed in on that, you're going to see something like this, right? And there's more Wyckoff in there, but we're not using that right now, okay? Let's follow that up. What do you see? Potential buying climax, AR, ST, upthrust that tests the upthrust here, making an overall test, which is also an upthrust of its own schematic, which is an uglier schematic, right? Comes down, and as it comes lower, it begins to accumulate, but never validates the accumulation and doesn't continue higher, but instead breaks down lower. As it breaks down lower, to make the ST and B, it makes a selling climax, AR, ST, a little bit of liquidity formation, ST and B. So again, we can get rid of that. ST and B, sign of strength, test. Of what? A potential mentfx block within a larger mentfx block, and that's what it's testing. And that's how we got into the sells in here before it broke lower. Because inside of this, if this, so the way you have to think about it is you have to start asking yourself questions like so. If this schematic is to be confirmed, which means if it is to get below here, then we should see some beginning price action of that happening inside of these zones here. So what you're going to notice with this in mind is that on lower time frames, and I can't get too low here because some time has happened since we've taken these trades, but inside of here, as price does break down and leaves behind new mentfx blocks, the test of those zones are going to act as lower time frame schematics, and those schematics are tradable. But the fact that they're tradable on lower time frames does not mean that they can just be held all the way to new lows. Because if this schematic isn't confirmed, it can very easily also come a little bit lower and then just take off substantially higher, right? And then you could lose this trade, which is why we then stress the importance of also partialing along the way, which means, partialing at lows, whatever it may be, or at areas of demand. Because until the higher time frame schematic, so again, all we have to do is zoom out to see schematics sometimes. You don't even have to go to the higher time frame. You see this? The second we zoom out, we know there's a schematic here, a schematic here, a schematic here, a schematic here, a schematic here. That's all part of this overall schematic here, which is part of a test. This UTAD is actually a test of another schematic here, because on a higher time frame, that's just the normal supply zone, right? So we know that there can be schematics that we can trade here that might not act as the actual move that takes lower. In this case, it did. So these sells that we were able to get into here actually took us to new lows into the demand zones that we wanted to take them into in these zones here, which is fine. And then it began to do what? Form another schematic. And most likely it will test and continue higher. But now what's interesting about the schematic? The fact that it's operating off of a higher time frame, because remember, we are consistently working between a multitude of time frames, and there's multiple ways to get involved. The only thing you need is a validated schematic. Just because there's not a valid schematic on one time frame does not mean there's not a valid schematic on another, right? Just because there's not a valid schematic on one time frame, does not mean there's not a valid schematic on another. These are all valid schematics that could have been traded. Even this one right here. Before this one even got validated. Okay? Before the large black one got validated. This is why it's important to understand the fractal nature of the market. And this is also why it's important to understand that the snowflake rule applies everywhere. There is Wyckoff absolutely everywhere. And the only way to distinguish or be able to trade it and be a part of the movements of proper accumulations or distributions is by partnering it with a already preset bias, which is based on section 1 and section 2 material. Okay? Because that forms your bias. Now, what's interesting about this is now we've had the real breakdown and the real move that caused the overall breaks that formed the real sign of weakness, right? And we're still bearish, was formed by what? This last up move. Now again, you can either use the mentfx block, the low to the high, there's your mentfx block. You can do that. That is a mentfx block move. Or you can refine it to your last possible up move before the down move happened. Because in here are the last mitigated orders, unmitigated orders, that might need to be mitigated before the test happens, right? Or in this case, the test has happened, or you can assume that it's happened. And now you're looking for a potential LPSY. Looking for price to play into it and trade lower. Notice how we're on a 15-minute chart. This will be the same thing. So it's perfectly valid for you to look for something like this, or to look for confirmations of more Wyckoff on a lower time frame in here. This is how I confirm things. This is why I only use manual entries and get involved at the best possible area on the lower time frames and then partial. Because I know there's always going to be confirmation, almost always. Because price will undergo this type of price action anywhere. Because whether you're on the monthly, the weekly, or the 5-second chart, the price will move the exact same way by way of grabbing liquidity, leaving behind supply and demand zones. On a lower time frame, it's going to leave behind a lot more, a lot quicker, and the only way to get used to it is by, working with some of the higher. So this can be fully fine. You have an accumulation that accumulates into this, but that accumulation, as you can see, and you have the breakdowns, and you can be targeting much lower, whatever it might be. I'm not 100% sure how you want to be targeting this, but notice how schematics unfold for you on all time frames. The only difference between multiple time frame entries and multi-time frame entries and stuff of that nature is that on the lower time frames, you're going to have a lot more schematics that you can be a participant in a lot faster. The only difference between a higher time frame and lower time frame is the amount of opportunities that will present themselves to you, right? Because there's going to be a lot less given what time frame you're looking at. That's just how it is. Let's go to a 4 hour here. Let's keep playing price out here, right? So you have multiple areas where you can look to be involved, right? And you can see that we've had a lot of this happen. We've had overall distributions form, distributions hold, and now distributions are distributing lower. And now overall we can have an accumulation forming, right? So potentially we might have an accumulation form here, and then we can look to take that higher. But this accumulation to form and then validate will take a lot of time. A lot of time. Think about just this distribution right here. This distribution from the stopping action to the buying climax, the AR, the ST, the UT, the UTAD, to the breakdown, to the test, to another breakdown, to the test of it, to the real breakdown happened over about, just the distribution alone to the breakdown happened in about 47 days. For it to get to where it is now, which is the real distribution, where it's distributing, it's 112 days, right? That's about a third of a year. This is why the lower time frames are part of our entire strategy, because we are day traders. Now, you don't have to do that. You can be part of a much larger overtime trader. But the thing is, your RRs are going to be the same. You're not going to be getting like refined RRs unless you go and refine them on the lower time frames and be involved in price in that sense. Okay. And just as a quick, as we look into this a little bit more, you can see how all these areas form the exact same way over and over. These buys look relatively like, what are we buying off of here, right? It's kind of hard to tell. What are we buying off here? You can't really tell. But the second we go into it, and oh no, please don't lag out. That would suck if it does. Hopefully it comes back in a second. There we go. Fantastic. So the second we actually get lower, maybe to like a 30-second, and get into what price was doing in these areas, our overall perception of the actual setups here changes. We start to see the accumulations occurring, right? We see potential breaks, we see the demand zones, and we see the accumulations occurring in these areas. Now, not all of them are clean. There's an accumulation here, right? There's accumulation here. I think this is actually the accumulation I traded, but on a lower time frame. Let's find out. Right? As we get even lower, notice what you're starting to see. More accumulations. You're seeing them present themselves. 5-second chart, you're going to see even more, right? Why is this? Because the inner workings of price action will consistently form for you multi-level accumulations, distributions, and things of that nature. Now, again, see how this 5-second chart formed a distribution here. But that distribution wasn't important to us because we were expecting, or at least I was expecting, bullish price action based on what? Section 1 and Section 2. And as price came into these lower points, what is it testing when it's here? Look at this. It's an overall accumulation. How so? Follow it. Selling climax. Okay? Or actually, big move down, stopping action. Preliminary support. Big move down, selling climax. Move up to the next swing, AR. Move down to the ST that doesn't get below, forming liquidity. Follow that up to the sign of strength in phase B. Follow that down to the ST and B that liquidates the ST. Follow that down to the spring that liquidates everything. Okay, now wait for the sign of strength that breaks past everything. As it breaks, you have the opportunity to get involved already at retests, like you see. We got involved on the retest of the schematic and took it higher with the low in mind. It looks large, but when you zoom out, you realize how tiny that area actually is. And the RR presented to you is much greater. You zoom back in and you recognize that you could have gotten involved on any of these, as we did, right? Because what was this buy right here based off? This buy wasn't based on this schematic. It was based on what? The previous schematic right here. Follow it back. Notice what happened. Even though this is an uglier schematic, and honestly, I probably shouldn't have bought this one. This was a little bit dumber. I bought it more based on the structural pushes higher, because at the same time that there wasn't really Wyckoff here, what is there? Big move down, move up. Mitigation of that, move up. What is that? Double mentfx block confirmation. Good to enter at the open. Notice where the stop loss is. The stop loss is a little bit wrong. I'm sorry. Just below the lows. So again, when we do this, I do it manually. So I watch this. And if price comes down through it, I close my trades out. But I enter them with a little bit less risk. So as you can see, price breaks higher. And again, it undergoes distribution here, right? Potentially you have a buying climax, AR, an ST, an upthrust, then a mini UTAD, a breakdown. And look at this. There's actually opportunities to take this lower, but there's no point for me because I'm looking for buys. And as it comes lower, what does it do? It undergoes a very, very ugly accumulation, right? But it's testing this accumulation, which is why we bought it. Okay, so these will happen everywhere. Doesn't matter what you look at. Now, there's also a 1 minute accumulation that I bought. Now, the accumulation that I bought wasn't a great RR, but the accumulation still stands. Let's talk about it, because I know that these 5 seconds can get very confusing for some people. Okay, let's zoom out here. Let's go into here. Let's take a look at where it was. Yep, there it is. Fantastic. So let's think about what happened here. We had on a higher time frame the same thing, right? We have a higher time frame, and we have an area where price is beginning to break and leaving behind unmitigated demand zones. Remember, a wick that goes below some kind of liquidity before and then continues higher is an unmitigated demand zone. Now, as price comes into that demand zone, notice what happens. Notice price action. This is the formation of a potential schematic. Try to label it. Do it either with me or without me, but let's label it now, okay? Preliminary supply. Preliminary support, doesn't matter, either one. Big move down, huge stopping action, preliminary support. Okay, great. Follow down. Where's the next move? Maybe selling climax, but then no, bigger move down. Okay, selling climax, fantastic. Your selling climax is here. Follow that up. AR, fantastic. Follow that down to your next swing. It could be here, but it's not really a swing. This is your next swing. Remember, your ST is usually going to be inside of the selling climax or a little bit above it, but it can go outside. That does not change it. It just means that the liquidity is being engineered a different way. For retail in this case, if you want to think about it, there's liquidity being engineered inside of this overall thing. So the reason for this as an ST is that retail is looking to continue buy and sell this overall channel or whatever they want to call it, right? There's always a retail explanation for the way liquidity is being created. But the reason that what we do works is because when we get involved, we're literally getting involved on potential liquidations of other people. So if there is a liquidation, there's also a higher chance that that liquidation holds and then moves in our presumed direction, especially when our presumed direction is based on a higher time frame area plus a lower time frame confirmation. So let's follow this again, right? Let's consider it all. Preliminary support. Follow that down to your selling climax. Follow that up to your automatic rally. Follow that straight down to your ST, which can be lower, but it's liquidity. Follow that up to what? Your sign of strike in phase B. That does not always happen, okay? But you can see that's why I use that as a BOS. Follow that down to your what? ST and B. Does it liquidate it? It does, but also it acts as now what? Liquidity. So now it's starting to bottom out in liquidity. And then what? You have your last down move through the lows. Now what's interesting, again, so you know already that this is your spring. Now what's interesting is, why was I taking buys here before it got above and validated the schematic? Because on lower time frames, there are schematics that are validated within this price action. And you can see them. We can already see them. There's a schematic here, a schematic here, a schematic here, a schematic here, even schematics in here that were all validated and could have been traded. And they were in line with your bias. Now, these are more risky. Why? Because they're further away from price. But because you're expecting this schematic to validate, these schematics are that much more powerful because they can be part of that validation, which are already part of larger RR trades. Okay? So in this case, you can now look at a 1 minute Wyckoff schematic, right? You can see how Wyckoff schematics present themselves absolutely everywhere. And it's impossible, at least for me, maybe for some of you, Houdini motherfuckers, it's going to be a lot easier. But for me, at least, I cannot look at a schematic and get involved on it. Maybe some people that use volume can, but for me, what's most important is understanding where I want to head, how I want to head there, and then using Wyckoff to see the orders transfer from one party to another and then get involved on the actual impulsive validation of that transfer. That is how you should be trading the markets. And that is what will always give you an edge, because you need to recognize that when you get involved on Wyckoff, what you're really doing is getting involved in the potential area that people got mitigated out of, right? That they got liquidated out of. On also potential mitigations of larger orders. And if you know that, then you know that over enough time, over a span of enough proper entries and proper management, you are set up for ultimately success. But that success will only come from proper backtesting. So in this case, what happens? We get all this and we get the real move up. Now what happened is I had these buys, but I also got into another buy where? On the break of this buy with a buy stop, because after this is validated, we have a valid schematic. Now again, this RR right here is not good. I partialed the original trade, of this one, not of these. These were partial too at much better RRs, but this one was partialed where? At this supply zone. Because there's no telling that price really did want to break higher. What actually happened is I actually partied out 1-to-1. I had it closed when I was away. But 1-to-1 off of a schematic is one of the ways that Wyckoff himself, the actual guy, used to trade. So I use that myself sometimes in my trading with lower risk on the positions, and then get involved on better risk within smaller confirmed areas, right? So there's a multitude of ways to get involved on this, but the first thing you need to understand is that Wyckoff occurs everywhere. And because it occurs everywhere, you need to have a way to validate your Wyckoff, right? And an area that you want to validate it inside of. Because if you just trade Wyckoff, it's going to be a fucking hassle. You are going to get so confused, and it will be confusing. Now, you're going to have some lucky ones if you just try to trade Wyckoff, but unless you're looking at overall movement and you're looking at overall areas you want to be involved in, it's going to become relatively complex to spot Wyckoff, which is why people that do learn Wyckoff find a lot of hardship with it and find it to be somewhat complex without recognizing that it's nothing more than everything they've studied thus far with the proper confirmation and understanding of what is actually undergoing in a given range. So thank you for watching, guys, and I will see you in the next subsection where we will talk a little bit about reaccumulations, redistributions, and kind of why they are less important to you than you really think, okay? So we'll see you guys in that one.